Technical analysis proposes various trading indicators and tools to help determine trends and anticipate reversals. Most traders prefer using the candlestick chart, since it can provide a number of patterns that anticipate trend reversals or continuations with a certain degree of accuracy. What is a candlestick? The candle body represents the open and close price of an asset. Each candlestick generally has two so-called shadows, or wicks, though this is not generally a rule. The shadows represent the high and low of a price for a given period. The color of the body shows the direction of price movement. Usually, a green or white body suggests a price increase, while a red or black body points to a price decline. You will likely see green and red bodies on most platforms. How do candlesticks work in trading? While there are plenty of candlestick patterns, we'll list the most popular and reliable ones, starting with bullish patterns, which show up after a downtrend and anticipate an upward reversal. First pattern we will talk about is hammer candlestick pattern. The hammer candlestick consists of a short body with a much longer lower shadow. It's called a hammer pattern because the candlestick resembles the shape of an upright hammer. As a rule, you'll find the hammer at the bottom of a downtrend. This pattern indicates that bulls have resisted the selling pressure during a given period, and have pushed the price back up. While there may be hammer patterns with either green or red candles, the former points to a stronger uptrend than red hammers. The inverted hammer is similar to the standard hammer pattern, but it has a much longer upper shadow, while the lower wick is very short. This pattern suggests buying pressure, followed by bears' failed attempts to drag the price down. As a result, buyers come back with even stronger pressure, pushing prices higher. Unlike the previous two patterns, the bullish engulfing is made up of two candlesticks. The first candle should be a short red body, engulfed by a green candle, which has a larger body. While the second candle opens lower than the previous red one, the buying pressure increases, leading to a reversal of the downtrend. The piercing line, which may show up at the bottom of a downtrend at the support level, or during a pullback with the anticipation of a bullish movement. The pattern consists of a long red candle that's followed by a long green candle. The critical aspect of this pattern is that there's a significant gap between the red candle's closing price and the green candle's open price. The close should also cover at least half of the length of the previous day's red candlestick body. The fact that the green candle closes much higher than the open points to buying pressure. The morning star pattern is more complex because it comprises three candlesticks, a long red candle, followed by a short-bodied candle and a long green one. The morning star pattern suggests that the first period's selling pressure is fading, and a bull market is forming. Another three-stick candle is the three white soldiers. It's made up of three long green candles in a row, generally with very short shadows. The primary condition is that the three consecutive greens have to open and close higher than the previous period. This pattern is regarded as a strong bullish signal that shows up after a downtrend. Next, we'll discuss a batch of bearish patterns that anticipate an uptrend reversal and usually come at resistance zones. The hanging man is formed by a green or red candlestick with a short body and a long lower shadow. It typically appears at the end of an uptrend and suggests a considerable sell-off is coming, but bulls could temporarily push prices higher, after which they'll lose control. The shooting star is the opposite of an inverted hammer. It consists of a red candle with a short body and a long upper shadow. Generally, the market will gap a bit higher on the candlestick opening and will surge to a local peak before closing just below the open. The body can sometimes be almost non-existent. The bearish engulfing pattern is the inverted version of a bullish engulfing, so the first candle has a small green body and is completely covered by the next long red candle. This pattern comes at the peak of an uptrend and suggests a reversal. The lower the second candle continues, the more momentum the bearish move will have. The evening star represents a specific three-stick pattern. It consists of a short-bodied candle that comes between a long green candle and a large red candle that closes below the midpoint of the first green candle. This pattern usually appears at the top of an uptrend and signals a potential reversal. The three black crows pattern comprises three long straight reds with short or almost non-existent shadows. Every new candle opens at relatively the same price as the previous one, but goes much lower with every close. It's regarded as a strong bearish signal. The dark cloud cover pattern is like the piercing line, but is its inverse. It anticipates a bearish reversal, and comprises two candlesticks, a red candle that opens above the previous green body and closes below its midpoint. This pattern suggests that bears have taken control of the market, pushing prices lower. If the shadows of the candles are short, then traders can expect a strong downtrend. Besides the bullish and bearish patterns that anticipate trend reversals, there are also candlestick patterns that are either neutral or point to the continuation of a trend, be it bullish or bearish. They include the following: doji, spinning top, falling 3 methods, rising 3 methods. The doji candlestick has an exceptionally small body and a long shadow. While it's generally perceived as a trend continuation pattern, traders should be careful because it might also signal a reversal. To avoid confusion, open a position a few candles after a doji when the situation becomes clear. Like doji, the spinning top is a candlestick with a short body. However, the two shadows are of equivalent length with the body in the middle. This pattern also indicates indecision, and may suggest a period of rest or consolidation after a significant rally or price decline. The rising 3 methods pattern is the opposite of the previous one, and can be observed during uptrends. The pattern comprises a long green candle, followed by 3 small red candles and then another long green. Falling 3 methods is a pattern consisting of 5 candles in a specific arrangement, indicating the continuation of a downtrend. It comprises a long red body, followed by 3 small consecutive green bodies and another long red body. The green candles' bodies are all covered by the bearish reds, demonstrating that bulls don't have enough power to reverse the downtrend.